Which investing legend matches your personality? What if the biggest factor behind investing success isn't how smart you are, but who you are? Think about it. Two people can read the same book, analyze the same company, and look at the same stock chart, yet make completely different decisions. One buys, the other waits. Neither is necessarily wrong. They're simply wired differently. Here's something many people overlook. The greatest investors in history didn't succeed by copying one another. They succeeded because they built strategies that matched their personalities. That's why understanding yourself may be the most valuable investment you'll ever make. Let's find out which investing legend sounds the most like you. If you're naturally patient, calm under pressure, and rarely feel the urge to chase what's popular, you probably have a lot in common with Warren Buffett. Buffett isn't famous because he predicts the future. He's famous because he refuses to let emotions control his decisions. While others panic during market crashes, he sees opportunity. Imagine two people shopping during a huge sale. One rushes to buy anything with a discount tag. The other carefully picks only high-quality products at lower prices. Buffett is the second person. His philosophy reminds us that patience often earns more than speed. But maybe patience isn't your defining trait. Perhaps you're someone who constantly asks why. You enjoy solving puzzles, connecting ideas, and seeing patterns others miss. That sounds a lot like Charlie Munger. Munger believed that great investing comes from building a broad understanding of the world, not just reading financial statements. Whether it's psychology, history, mathematics, or biology, every field offers mental models that help you make better decisions. If you're the kind of person who loves learning simply because you're curious, Munger's approach may feel natural. Now consider Benjamin Graham, often called the father of value investing. Graham believed that the market behaves like an emotional person who swings between excitement and fear. Instead of following those emotions, he searched for businesses selling below their true worth. Think about someone buying a perfectly good car simply because the owner is desperate to sell quickly. Graham looked for opportunities just like that. If you're analytical, disciplined, and comfortable ignoring the crowd, his philosophy might suit your personality. Then there's Peter Lynch, who believed ordinary people often notice great investments before professional investors do. Maybe you've seen a restaurant that's always packed, a product everyone suddenly seems to use, or a company your friends can't stop talking about. Lynch encouraged investors to pay attention to the world around them. His advantage wasn't predicting the future, it was staying curious about everyday life. If you're observant and enjoy connecting real-life experiences with business opportunities, you might share his mindset. Some personalities are drawn towards caution rather than excitement. Howard Marks is one of those investors. He often reminds us that successful investing isn't about making the highest returns. It's about managing risk when everyone else forgets it exists. Imagine driving on a rainy night. The smartest driver isn't necessarily the fastest. It's the one who understands the conditions and adjusts accordingly. If you're naturally careful, thoughtful, and willing to wait until the odds are in your favor, Marx's philosophy may resonate with you. Others thrive on understanding how entire systems work. That's where Ray Dalio stands out. Dalio studies economies like giant machines, looking for repeating patterns across decades. He believes emotions cloud judgment, so he relies on principles and data to guide decisions. If you're someone who enjoys solving complex problems, creating systems, and thinking years ahead instead of weeks ahead, Dalio's approach could feel like home. And then there's John Templeton, whose greatest strength was independent thinking. While most investors looked where everyone else was looking, Templeton searched for opportunities in places people had already given up on. He understood something timeless: fear often creates bargains. Imagine walking into a nearly empty bookstore during a storm while everyone else crowds the shopping mall. Sometimes the quiet places hold the greatest treasures. If you're comfortable standing alone and making decisions based on careful research instead of popular opinion, Templeton's mindset may match yours. Here's where things get interesting. Most people spend years searching for the perfect investment strategy, when the better question is whether that strategy actually fits their personality. An impatient person trying to invest like Buffett may quit too soon. An highly emotional investor attempting Graham's disciplined approach might struggle during market downturns. Even the best strategy fails if it constantly fights your natural temperament. The legendary investors weren't legends because they copied one another. They became legends because they understood themselves first. They knew their strengths, accepted their weaknesses, and built investing habits that matched who they were. So which investing legend sounds most like you? Are you the patient Buffett, the endlessly curious Munger, the disciplined Graham, the observant Lynch, the cautious Marx, the systematic Dalio, or the independent Templeton? Share your answer in the comments. I'd genuinely love to know. If you enjoyed this journey into investment psychology, subscribe for more videos exploring the timeless wisdom of history's greatest investors. Remember, the best investment strategy isn't the one that works for someone else. It's the one you can confidently stick with for decades.